Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
We welcome to the program Bob Savage, Head of Market Strategy and Insights at BNY. Joining us here in our studios in Hong Kong. Bob, thank you very much for coming in. So we mentioned that Asian stocks cautiously lower today. We had U.S. stocks cautiously higher. I guess it's a week to be cautious with all those big events this week. How are you approaching this kind of avalanche of data?
So it's interesting you say that, Brian, and thank you for having me. I wrote about this week ahead as a parallel universe. Last week was a pretty miserable one for stocks. And is this week going to be the same? Well, imagine a universe where politics just don't matter as much because the race is too close to call and we just don't know what we don't know yet. So, just cast that aside. Imagine if earnings came out on expectations and you didn't have any great volatility of nerves around the Magnificent Seven. And finally, imagine the Fed actually talking about cutting and makes clear that September is on the table. All of those things, if you put them together, make me risk on.
Yeah.
So I'm not really that bearish. I understand the caution because you just got run over, and it was the worst day on Wednesday last week that we've had since 22. But I'm not a bear.
Okay, so if you want to be long right now, is there a strategy that you're using? Be tactical here for a moment. Do you put more money to work in areas away from technology?
So that is the whole premise of the rotation trade in my mind, which is there are 493 shares in the S&P that might beat earnings expectations. And if the equal weighted S&P rallies back, it's on that basis, a bottoms-up analysis, that the economy is doing better. When you have 2.8% second quarter growth, you would expect second quarter earnings to follow suit and even things out in the economy and not just be a AI-hyped boom of investment flows. So tactically, yes, the rotation trade makes some sense. It's just a question of which sectors and, choose wisely. I also think that in the longer term and bigger picture, markets are pretty worried about, a normalization, not just here in the one or two sectors, but also across the whole world.
It seems like since we've got two big camps, the 493 and the 7, that, coming through this earnings season, you'd have thought that if the mega caps traded sideways to slightly higher, that you'd probably want to overweight some of the 493. But they didn't. The top 7 actually got hit pretty good here. We mentioned that NVIDIA from an intraday level is down 20% now off the high. So it's almost like now it's time to be looking back at the Mag 7.
Yeah, so the historic experience of whenever you have 40% of the S&P market cap geared towards one major sector, you normally have a correction. So are we in the midst of that correction? Perhaps. I'm not convinced that it's over yet, but the proof will be in the pudding. I'm more concerned about how our client base has shown this predilection to caution before the earnings and then all in after the earnings. And let's be clear also, when I look at our data set, and we have, Bank of New York is known for the movement of capital, the management of capital, and the safekeeping of capital. The world has $50 trillion of money with our custody, and we measure that every day. So when I look at the flow into equities, it's positive. It has been positive. And the question of whether, the selling that we're seeing is cautionary into earnings and then they'll buy it back, that has been the modus operandi over the last, year. So is this time different is the question to ask.
So of the 50, what was the number you threw out there?
50 trillion.
That's amazing. How much of that is in cash?
Not as much as you'd think.
It's around 6, isn't it?
It's a little less than that. Okay. And it depends on what you mean by cash.
Or cash equivalent.
Yeah, exactly. Cash equivalents to which we measure. I think it's more like 4.5%. It's down from the highs.
We've got a story with Heineken here, so we can bring it around to China for a moment. Heineken bought into China Resources Beer. It's not like anything really terrible has happened, but because that stock has gone down a ton, Heineken had to take a big impairment charge, and the stock went down 10% in the latest session. So how are you looking at China now, risk versus opportunity?
So I'm actually, I would call my view on China benign neglect. What do I mean by that? You just have to give them time. Their markets are pretty much at rock bottom. Can they go lower? Sure. It's like a crab crawling along the bottom of the ocean. Are there little bumps along the bottom? Sure. I'm not convinced that anyone that has put their faith in the consumer in China is going to get rewarded right away. But in the longer term, I think the policies that they're trying to put into place are going to eventually work. It's just a question of, is it a year, is it 2 years? And how do you wait with benign neglect?
You're here in 10 seconds. What are you doing?
So in 10 seconds, I like the idea of being long yen into the...
Okay. All right. Interesting. Yeah. It's this is a big week. We got the BOJ, we got the BOE, and we got the Fed. Anyway, Bob, thank you very much. Bob Savage there from BN1. In China, more small to medium-sized banks, such as city commercial lenders and rural banks, may cut their deposit rates soon. That's according to a report by the Shanghai Securities News. You wonder what that does for people and their deposits. We're joined now by Jing Liu, Greater China Chief Economist at HSBC Global Research. So clearly, this is the type of move. It's not really central to what's happening in China, but it's not good for consumers, and that's the sector of the market that policymakers would like to stimulate, but it does help the bank's margins.
Yeah, I think it's important to some extent that banks still has reasonable profitability. And I think the change indeed may not be good news for depositors, but this is along the line that China also want to encourage the household to diversify their asset allocation. So if actually there's more options on different kind of asset investment, maybe they can divert into those.
Is there a way for the government to kind of coordinate a reduction in the rate that deposits at banks are yielding?
Well, I think, it sometimes comes in the format of the communication, the window guidance, but the banks actually have certain level of discretion on how they want to do that. In the past, we also observe some banks try to circumvent the regulation one way or the other. I think the concern from the regulator's perspective is that they don't want the banks to engage in the fierce price competition to the extent that they hike up the deposit rate massively, just try to keep their market share or expand. That happened last year. In some cases, the smaller banks end up with inverted net interest margin.
So we're looking at everything in China really to get a feel on when the animal spirits might be released. For instance, the box office was pretty good for that blockbuster film that just came out. And also the smartphone shipments in June were up 14.3% year on year. Now, we got this from the China Academy of Information and Communications Technology, an institute under one of the industry groups. So it's kind of interesting that there are pockets of strength, but it's going to take a while.
Yeah, I agree with you. I think we do see the pocket of strength, especially, those relatively cheap items. I think because of the purchasing power from the lower income group has improved after the end of the pandemic, especially because of the certainty in their jobs, etc. So we have seen a lot along those lines. And also after the pandemic, people emphasize more on experiencing different things. So services consumption continue to perform well. But overall, we need the household balance sheet improvement continue to make progress and also the labor market outlook to improve, to see the broad-based animal spirit to come back.
What is your recipe or a prescription that you would offer the authorities in China when it comes to addressing deflation? Is it something where a lot more in the way of fiscal stimulus is needed? Is it a different way in approaching monetary policy? What's the prescription here?
I think, there are different things. First of all, the consumer sentiment, if there is substantial improvement, that can help. And I think, that will depend on what's the next step in terms of the housing market measures and other things. And the other thing I want to mention is that usually in China's history, when we observe the deflation, especially on the PPI end, some level of consolidation by the upstream industries, like to tackle the overcapacity problem usually help quite a bit. And we do see steps trying to tackle that.
Yeah, it's hurt companies and their stock prices for sure. I mean, there's deflation in the producer prices sector, but not in consumer prices. Companies are struggling a little bit with this.
Yeah, I think we have observed one reason which actually has caused a lot of concerns by trading partners is this price competition among different manufacturers. I think to some extent it might be a reflection of the perfect competition, but at the other end of the story might be we still see some of the companies which should already, exist but still continue to survive. That is why in the third plenum, we see there's a specific mention that China will actually go after the local government, which might engage in illegal stimulus or tax breaks for companies. And I think if that's the case, that can help deal with the overcapacity problem. And also, we have seen the measures to push for the green transition actually will call for, a certain standard of emission, for example, which means those not so ESG type of producers might eventually exit the market as well.
Jing Liu, last question here, and it's about tariffs. I mean, what could increased tariffs from the United States and the tariffs that we already have in place from Europe, what could that mean for China?
Well, I think this is probably a very complicated process. It will involve the dynamics, such as, the interaction between China and other trading partners. And I think Chinese government is now proactively engaged in conversations with different trading partners, try to mitigate the potential tariffs and offer to invest more to replace the export.
Jing, thank you for joining us. Jing Liu, Greater China Chief Economist at HSBC Global Research.
Let's bring in Bloomberg M-LIV strategist Mark Cranfield, who joins us from our studios in Singapore. Mark, it's always a pleasure, especially when we have three major central bank meetings to talk about this week. Can we start with the BOJ, because there's been so much strength lately in the yen? I think it's a reflection of the market betting that we're going to get two things from the BOJ this week. Maybe that would move in the direction of policy normalization. A rate hike and a commitment to reduce bond buying. Is that fair?
Yes, I think that's exactly a big part of the reason why the yen has a pretty good run for the past couple of weeks. But at the same time, it raises the stakes dramatically for this Bank of Japan meeting, because if traders remember pretty well what happened in June, going into that meeting, there were also expectations that there would be some form of policy tightening, which didn't happen at all. There was no change. And even in the press conference from Governor Ueda, he actually seemed to dial back and sounded quite dovish. And of course, that was the trigger for dollar yen to rise towards the 162 area. Since then, we had some intervention and we're back to levels in the 150s again now. So the stakes are very, very high.
I wanted to ask you about the unwinding of the carry trade. It's one of the things that's gotten some credit for the sell-off in mega cap tech because, the trades that a lot of people were lined up on was shorting the yen and going long mega cap tech. And then when the yen all of a sudden boomed from 161 to 153, that caused a lot of people to have to, cover their shorts and sell. I realize there's a lot of different prongs here, but this is certainly one that got some attention last week.
I think that's a convenient explanation. I think it's more of a coincidence. Mm-hmm. I suggest that actually what was going on is you had portfolio reduction to cover P&L losses, or at least reduced P&L prospects anyway. So two of the biggest trades, and they're not the only trade, but two trades that have had a big theme are being long of the big tech stocks, particularly with the AI narrative, shorting the yen against a variety of currencies, not just the dollar, but also the euro, Aussie, others as well. It coincidentally, at the same time as people became more hawkish on the Bank of Japan and fairly confident that the Federal Reserve would announce a rate cut pretty soon, that helped the yen move. At the same time, we had weak earnings and people thinking that the AI narrative had been well overdone. The two coincided. It meant that quite often you would find there'd be portfolio managers who had both trades. They would have the tech trade, they would have the yen trade, they would have others as well. Suddenly, they're reducing positions all over the place.
Let's get back to the policy side. Interesting piece in the New York Times here today indicating that Japan wanted higher inflation. It's here and it hurts. Do you think the BOJ waited too long to kind of make major changes to policy? I know it's a kind of subjective point of view, but I'd like your thought.
I think there's a reasonable case that they're behind the curve. I think if any central bank around the world can be accused of taking too long, it probably is the Bank of Japan. I think they fumbled the opportunities. The window was there pretty clearly. After they raised interest rates in March, there was clearly a window for them to follow up in April to increase again. They only moved by 10 basis points. So really, they could have done another small move in April and probably another small move in June. Here we are, three meetings later, and now they finally look as though they're going to move forward. But they could have done it before.
Hey, Mark, I'm kind of curious about one other big mover in markets over the past couple of weeks, the rotation trade, or at least some sort of broadening out of the markets there. You've got people like Mike Wilson at Morgan Stanley saying the dimmer outlook for corporate earnings will hurt stocks that are tied to the economy. And Lori Calvasina at RBC Capital Markets said that trends in earnings revisions don't yet support a further rotation. Have you been looking at this, and did you see this as a healthy move or perhaps not a very wise one?
I think rotation is a good thing. There have been times this year when people have said that the moves, particularly in the S&P 500, are too concentrated, particularly on things like the big seven tech names, the so-called Magnificent Seven, driving too much of the market. So anything that spreads out the market into other sectors as well, obviously is a good thing. But the interesting point about this is we come out to a huge week. This week we got 4 of the biggest tech companies reporting. Just them alone is worth something like $12 trillion between the 4 big tech stocks, and we still haven't had Nvidia. So if we get stories which are more AI positive and that narrative rebuilds, I suspect that we won't be seeing much in the way of rotation after that.
You want to make a bet? What do you think we're going to get in aggregate when we hear from Apple, Amazon, Microsoft, and there's one more?
Yeah, and you can throw Samsung in there too.
Yeah, Meta platforms, yeah. In aggregate, what do we get? Is it going to be positive or is it going to be risk-off when it comes to these big 4?
I think we do okay. I think for me, the big one is Microsoft. I think they will have the clearest view on the AI world because of their relationship with ChatGPT. They'll give us the best read on what's going on.
Mark, it's always a pleasure. Thanks for making time to chat with us. Mark Cranfield there, Bloomberg M-LIV strategist. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.